Welcome back to Investing Talk Podcast.
Great to be here.
Today, we're tackling a listener request, actually. We're looking into Dragonfly Energy, the company that had that massive run-up recently and then, well, quite the pullback.
Yes, Dragonfly, specialists in those lithium-ion solutions for RVs, marine, off-grid stuff, niche sectors.
Exactly. And the big question our listener had, the one we're really zeroing in on today is this stock a good time to buy right now?
It's the key question, given the volatility.
We're going to dig into their recent earnings, which had a bit of a surprise, look at some, let's call them balance sheet concerns, and see if this recent dip actually creates an opportunity.
Sounds like a plan.
And hey, before we jump in, if you find this kind of focused market analysis valuable, please do hit subscribe, give us a like, maybe drop a comment below.
Definitely.
And specifically, if there's a company you want us to analyze next, maybe one that's showing some strange chart behavior or facing big news, just put the name in the comments. We'll add it to our list.
Yeah, we love getting those suggestions. So Dragonfly Energy, it's a really interesting case study, isn't it? High risk, potentially high reward.
What makes it so interesting from your perspective?
Well, what they do is pretty critical. They build these advanced lithium-ion batteries, but they smartly avoid the super crowded electric car market.
Right, they focus elsewhere.
Exactly. RVs, boats, solar setups for homes off the grid, even industrial gear. Areas that are often underserved but need this tech.
Higher margins there, maybe?
Potentially, yes.
Right.
That's the idea. The analysis we've got suggests they're riding a big wave of electrification, but they're doing it under some serious financial pressure.
So high growth potential.
But high volatility, too. Lots of cash being burned. Our job today is to cut through that noise and see if the growth story holds up against the financial realities.
Okay, let's start with the financials that caught everyone's eye. Q2 2025 performance.
Right.
Revenue came in at $16.25 million for the quarter. That puts their trailing 12-month revenue, the TTM, at $54.54 million. So definite growth happening year over year.
Solid top-line momentum, yeah.
But the real kicker was earnings per share, the EPS. Analysts were bracing for a pretty bad number, like negative $0.29 per share.
Yeah, expectations were low.
And Dragonfly actually delivered negative $0.58. Still a loss, obviously, but way, way better than expected.
A substantial beat. It showed they're maybe getting a handle on things faster than the bearish case allowed for. That's definitely a positive signal.
But you mentioned financial pressure earlier. Does this beat change that picture?
It's a sign of operational progress, absolutely. But we need to put it in context. Revenue's up, great. Profitability, that's still the major hurdle. The TTM net loss is, well, it's significant, $30.45 million.
Okay, so still losing quite a bit of money overall.
And look at the net margin. That's a really telling metric here. It's sitting at negative 55.84%. Heavily negative.
Wow, minus 55%. What does that practically mean?
It means, simplifying a bit, for every dollar of product they sell, they're currently losing about 55 cents just on the costs of making and selling it. The operating leverage just isn't there yet.
So they're spending a lot to get those sales.
Exactly. It's like running a powerful engine, but it's still guzzling cash, constant cash burn.
But hang on, isn't that typical for growth companies, especially in a hot sector like electrification? Don't they all burn cash early on?
To an extent, yes. But this negative margin, combined with other factors, feels a bit more concerning. It suggests they haven't reached the scale needed for basic production efficiencies.
And that strains the balance sheet.
Immensely, particularly liquidity, which brings us to the balance sheet itself.
Let's look at that. You mentioned red flags.
Yeah. If you glance at the assets and liabilities, you see liabilities are at $88.37 million, and that actually exceeds their assets of $71.77 million right now.
Not ideal.
Not ideal at all. But the real siren is the quick ratio. It's down at 0.3, extremely low.
Okay, explain the quick ratio significance. 0.3 sounds bad.
It is bad. It measures a company's ability to cover its immediate liabilities with its most liquid assets, basically cash or things easily converted to cash. A ratio below 1 is concerning. 0.3 is, well, it's a serious warning sign.
Meaning they don't have much readily available cash to pay near-term bills.
Precisely. They're very reliant on turning over inventory quickly or getting more funding just to manage the short-term obligations. It signals constrained liquidity. Big time.
But that sounds pretty precarious. So why would anyone be bullish here? What's the counter argument?
It comes down to their tech and their niche. They aren't just selling a commodity battery. They offer a whole ecosystem, right? Solar panels, inverters, monitoring systems.
The whole package for their target markets.
Exactly. And crucially, it's built around their own proprietary battery management technology, specifically for deep cycle lithium batteries.
What's special about deep cycle? And why can't, say, a huge battery maker just jump into the RV market and crush them?
Good question. Deep cycle applications are different. Think about living in an RV off-grid or powering a boat systems for long periods. These batteries need to handle wide temperature ranges, be discharged very deeply over and over, and last a long time without failing.
More demanding than a typical EV battery, maybe.
In some ways, yes. The control systems, the battery management needs to be highly customized for that reliability. Big manufacturers. They're usually focused on mass production, standardization for cars. Dragonfly's edge, their moat, if you like, is that specialized expertise.
Okay, so that niche focus gives them some defense.
And potentially some pricing power. It makes them a key partner for the vehicle or system manufacturers in those sectors.
But that doesn't solve the immediate cash crunch, the 0.3 quick ratio.
No, it doesn't. Which is why they recently did something necessary but often painful for shareholders, a $25 million public offering.
Selling more stock, right.
Exactly. It raises cash, which they desperately needed to address debt and just get some breathing room financially. That's the positive.
The negative being?
Dilution. More shares outstanding means each existing share represents a smaller piece of the company. It almost always puts downward pressure on the stock price, at least initially.
Which we saw happen here after the offering news.
Yep. A necessary evil, perhaps, to survive and hopefully thrive later.
Okay, so financials are strained, they raise cash via dilution. Let's talk about the stock price itself. What are the charts telling us?
Well, like you said earlier, it's been a roller coaster. That surge over 400% in just 1 month recently. That's wild.
What does that kind of move tell you? Just hype?
Not just hype, it shows extreme sensitivity to news. It also screams short squeeze potential. When a stock moves like that, anyone betting against it gets nervous, and their buying to cover losses can fuel the rally even further. That potential is now kind of baked into how people view the stock.
Makes sense. And after the dilution news caused the pullback.
It seems to be finding its footing. The analysis suggests the price is consolidating now, kind of trading sideways in a range between roughly $1.08 and $1.30.
Any key levels to watch?
Definitely. Support around the $1 mark looks critical. That's the line the bulls really need to see hold. Resistance is clearer up near $1.30 for now.
What about Wall Street analysts? Are they scared off by the financials or excited by the tech?
Generally, they seem focused on the longer-term story. The consensus rating right now is actually a strong buy.
Strong buy, even with the liquidity issues.
Yep. And they've put out a 12-month price target averaging around $1.50. Compared to where it's trading now, that implies, maybe 38% upside potential over the next year.
Interesting. What's driving that optimism?
The technical suggests the stock might be moving out of that oversold condition, post-dilution shock, maybe entering an accumulation phase where savvy buyers start stepping in. Plus, there's news suggesting market expansion.
You mean beyond just RVs and boats?
Exactly. They recently announced a collaboration with PACCAR.
PACCAR, the truck manufacturer. Kenworth, Peterbilt.
That's the one. A major player in commercial vehicles. They're working together on a white paper about using lithium power solutions in the heavy-duty trucking industry.
Okay, that's potentially huge. A white paper isn't a contract, but
it's a very strong signal.
Yeah.
It shows a clear strategic push towards commercial vehicle electrification. That's a massive potential market for their specialized battery tech, much larger than their current niches.
That's definitely a catalyst to watch long term. But for traders looking maybe shorter term, what's the immediate thing on the horizon?
There's one date that really stands out, November 13th, 2025.
What happens then?
That's when their Q3 2025 earnings are scheduled to be released.
The next report card.
Exactly. And given they smashed expectations last quarter, this report becomes the single biggest potential trigger for the stock price in the near term, if they manage to beat estimates again.
Especially on profitability metrics.
Right. If they show continued improvement, the technical setup suggests you could see a significant move upwards. A breakout is definitely possible.
So November 13th is key. Any other catalyst besides earnings?
I'd be watching closely how they talk about deploying that $25 million they just raised.
Yeah.
Is it all just going to pay down debt? Or are they earmarking some for specific growth projects, like pushing those OEM partnerships forward?
And the PACCAR thing.
Yeah, any concrete follow-up there, an actual pilot program, a supply agreement, anything beyond the white paper would be very significant news.
Okay. Makes sense. So lots of potential catalysts, but let's circle back to the risks. We can't ignore those.
Absolutely not. Despite the analyst optimism, this is still very much a high-risk speculative investment. Anyone thinking about jumping in needs to be eyes wide open about the downsides.
What are the core risks again?
Fundamentally, it's twofold. First, liquidity. That 0.3 quick ratio we talked about, it means they're operating with very little financial cushion. They're kind of running on fumes, financially speaking.
And the second.
Persistent losses, that negative 55% net margin. Until they can prove they can scale operations profitably, they remain critically dependent on raising more capital.
Burge market risks, right.
Definitely. The battery sector is incredibly competitive. If bigger players do manage to crack the deep cycle niche effectively, Dragonfly's moat might not be as strong as hoped. Commoditization is always a risk.
And the need for more capital means.
The risk of further dilution. If they have to sell more shares before becoming profitable, it hurts existing shareholders. It's a constant balancing act for management.
So we've weighed the growth story, the niche tech, the catalyst-like earnings against these pretty serious financial and market risks. Where does the overall analysis land? What's the verdict from the reports you looked at?
The consensus view, synthesized from the analysis, actually assigns it an overall bullish rating of 8 out of 10.
8 out of 10. That seems quite bullish given the 0.3 quick ratio and negative margins. What justifies that level of confidence?
It's really a bet on execution, backed by two things. One, the powerful secular trend of electrification, just huge underlying demand growth. Two, the current technical setup. The stock has pulled back, found support above that key $1 level, and seems poised technically for a move higher if the catalyst hits right.
So the market seems to be giving management the benefit of the doubt for now.
It appears so, betting that they can navigate the cash crunch and capitalize on the growth opportunity, especially with that November earnings day looming.
Which means the timing of an investment here is critical. The analysis suggests different approaches depending on your time frame.
Absolutely. For shorter-term swing traders, the focus is probably Q4 2025, trying to capitalize on the run-up to and the reaction following that November 13th earnings report.
Riding the catalyst wave, essentially.
Pretty much. For longer-term investors, say looking into 2026 and beyond, the risk-reward profile could be attractive. But, and this is a huge but, only if management truly executes.
Executes meaning?
Meaning, they have to demonstrate a clear path to profitability, show that they can scale efficiently, improve those margins, and manage their cash flow effectively. Without that execution, the long-term case weakens considerably.
Okay, let's try to wrap this up. Quick summary. Dragonfly Energy. High potential reward.
Yes, driven by big market trends in electrification and that immediate earnings catalyst coming up on November 13th.
But balanced by?
Serious financial risks. Liquidity is tight at that 0.3, quick ratio is key, and profitability is still a major challenge.
So, for you, the listener, what's the number one thing to watch going forward?
It's all about how management uses that fresh $25 million. Watch their announcements, listen to their earnings call. Are they just plugging holes in the balance sheet, paying down debt? Or are they strategically deploying it to fuel growth, accelerating product development, signing new deals, maybe advancing that pack car relationship? Smart use of that capital is crucial to validating the bullish outlook.
Prudent management is key.
Essential. Okay, so here's a final thought to leave you with, considering the stock's volatility and that pack car news.
Go on.
If that PACCAR collaboration actually develops into a real significant supply agreement, think about the scale difference. How quickly could that kind of volume help them fix their gross margin problems? And if that happens, what does it do to Wall Street's $5 50-10 price target? Does it suddenly look too low?
Interesting angle. That shift to commercial scale could be transformative if it happens. Food for thought as we watch that critical Q3 earnings day.
Definitely something to keep an eye on.
Excellent analysis. Thanks for breaking that down. We will see you next time on Investing Talk Podcast.